Order blocks are special supply and demand zones that show us the accumulation of institutional orders. And we, like retail traders, can benefit enormously from these order blocks. We can refer to order blocks as the trading footprint of big financial institutions. But here, as a beginner trader, you might be wondering, well, what is the significance of order blocks? How can you detect and trade them? Don't worry, we will cover everything in detail from the basics of order blocks to advanced strategies in this video. And as a bonus, we will also announce the order blocks indicator towards the end of this video with a solid trading strategy. So without any further ado, let's get started. First of all, let's look at the definition of order block. Order blocks in Forex refer to the collection of orders of banks and institutions. The banks cannot just open a buy or sell order within a single trade because of the market's liquidity. So they have to distribute a single order into small chunks to maximize the profit potential. These chunks of orders are called order blocks in trading. For example, let's say Goldman wants to place a long order of 500 million on GBP USD, but only 100 million are being filled. This is due to liquidity because for every buy order, there must be a sell order. The transaction of all buy and sell orders happens in market from liquidity. Goldman will not be able to execute all their 500 million in one trade because there is not enough liquidity or sellers who are willing to sell to them the 500 million at specific price. By splitting their 500 million positions into series of smaller positions, let's say into 20 million block orders, it would allow Goldman's orders to be filled and their trades will be executed at the price they want without chasing the market or disrupting the current market. Also, don't forget to like this video and subscribe to our channel because we have a lot of great content planned for you in our upcoming videos. Now let's understand how you can find the order blocks. As we have stated, order blocks are accumulation of orders of banks and institutions. So to detect the order blocks, we should first learn to successfully see the order accumulation technically. In technical analysis, orders accumulate in that area where there is ranging market structure or the price moves inside a horizontal block. An impulsive wave will form after the orders accumulate and break the block or price range. This impulsive wave shows the imbalance in the market and it forms a price trend. So this price movement for the formation of order blocks can be categorized into two steps. The first one is where the market moves inside a range. This is the area where the accumulation of orders happens. The second one is the impulsive move of price away from the order block, which creates the imbalance. After the impulsive move, the market will move back towards the order block zone in order to pick the pending orders, and we will trade the order block zone when the price returns to order block zone in future. Now that you understand what order blocks are, let's look at the different types of order blocks. So there are basically two types, the bullish order block and the bearish order block. When a bullish impulsive wave forms after the break of ranging market structure or block, it indicates the formation of bullish order block. When a bearish impulsive wave forms after the break of price from a range or block, a bearish order block forms. Now let's talk about the detection of order blocks, and I would request you to pay close attention because if you miss anything in this section, you will have hard time understanding the strategy for trading order block zones. There are two ways to detect order blocks. The first one is detecting the order blocks manually, and the second one is using the indicator. So in order to detect the order blocks manually, you should look for the areas where the market gives impulsive move, and the area before that impulsive move should be a ranging market structure. In an impulsive move, the market should make consecutive bullish or bearish candles depending upon the type of order block. For example, here on the screen, you can see the market moving inside a range in this area. And then after this range, there is a very impulsive move in the bullish direction. This fulfills the conditions of bullish order block formation. We can draw the bullish order block zone at the high and low of this ranging market structure. Similarly, here on the charts, we can see the market breaking out of this ranging structure impulsively in the bearish direction, representing the formation of bearish order block. and the bearish order block can be drawn at the highs and lows of this ranging market structure. While detecting the order blocks, you should keep in mind that the impulsive move should be represented by clear formation of big-bodied candles, and all candles in the impulsive move should either be bullish or bearish. For example, this move here cannot be taken as an impulsive move for the formation of bullish order block because candles inside this move are not all big-bodied bullish candles. So this is how you can manually detect the order block zones. The second way, and the way which I prefer, is to use the order blocks indicator. I have put the link to the indicator in the description of this video. When you apply the indicator to a chart, it will automatically start running the order block zones in real time, and it also has an alert function to notify you once a new order block zone forms. This feature allows you to analyze multiple pairs for the formation of order block zones at the same time, which is very effective. For example, here you can see I have added the alert to all these currency pairs. Now, as soon as an order block forms in any of these pairs, the indicator will notify me through an email and also show the notification on desktop and mobile device. So after that, I can go to charts and see if the order block zone that is detected is tradable or not. That's right, because all order block zones are not tradable. In order to find the high probability zones, we have some confluences. One of the confluences is the formation of candlestick pattern when the price returns to the order block zone. Here on the chart, we can see the indicator has detected an order block zone. So as soon as the zone formed, the indicator gave us this alert. Now we can click on this alert and go to the charts. So once we are on the chart, we will wait for the market to come back to this order block zone. And when the market reaches this zone, we should get ready to see if there is formation of any candlestick pattern that indicates the reversal of trend at this zone. One such pattern is the formation of inside bar. For example, here we can see the formation of bullish inside bar. And if the market breaks above this inside bar candle, that means now the trend will get reversed from bearish to bullish. So we can use this bullish order block to take long trade. The stop loss level for this trade will be the low of the zone, and the expected take profit levels can be 61% and 100% retracement of this bearish move. This is just one confluence and one strategy. We have discussed more confluences and strategies in detail inside the video bundle that comes with the order block indicator. We can also see this table at the bottom right of the chart. This table shows us the highs and lows of the order block zones and also gives us an idea about overall trend in the market. Now let's have a look at the settings of the order blocks indicator. In settings, we can change the number of candles that are required for the formation of order blocks. For example, if we change the number of candles to 7, the indicator will only detect the order block zones in which there are 7 or more than 7 candles inside the impulsive move. Another thing we can do inside the settings of indicator is the customization of colors of order block zones. For me personally, I like to keep the bullish order block zones as green and bearish order block zones as red. So using this strategy, we have been able to take trades with a risk to reward ratio of 1:8, as you can see on the screen. So using the order blocks indicator in your strategies is not only logical but also essential, because if we do not take into account the trading activity of institutions, we will end up on the losing side. I hope you liked this video. Please make sure to subscribe and press the bell icon for upcoming videos. And if you have any questions, please make sure to comment down below. Also, if you're interested in subscribing to the indicator, please make sure to check the links in the description. See you guys in the next video. Thank you.